So January's inflation reading was up. Does that mean mortgage rates are going back up? Wait. You're probably saying to yourself, didn't we just hear something about mortgage rates dropping in mid-December? After the Fed signaled multiple rate cuts in 2024 because of encouraging data suggesting inflation would intersect their target inflation rate of 2%. Now you're probably wondering, are interest rates headed back to 8%? Hi, I'm Christopher Marr with MMG Real Estate Advisors, and I've been selling real estate in Orange County and surrounding counties for over 30 years. Brooks and I believe that confident real estate decisions are a direct result of how well informed one is. So, let's get informed. Now sure, the CPI came in a little hotter at 3.1% than its forecast of 2.9%. Remember that December's reading was higher at 3.4%. Now the Fed will meet 7 more times this year, with the next one being in March. But don't hold your breath that the Fed will cut the Fed funds rate at their March meeting, as the CME Fed Watch is currently predicting at 89% that the Fed funds rate will remain unchanged. That said, we'll be waiting for the PPI, the Producer Price Index reading on February 16th, and the PCE, Personal Consumption Expenditure reading on February 29th, which should give us some additional insight on inflation trends and, more importantly, the Fed's bias. Remember, PCE is the Fed's preferred inflation measure because the index tends to show inflation trends that are less affected by short-term price changes. A big misconception among some consumers is that the Fed must cut the Fed funds rate for mortgage rates to trend downward. This couldn't be farther from the truth, but the perceived bias of the Fed is extremely important to how much mortgage rates move. As you can see in this chart, the Fed has not cut the Fed funds rate since it began raising them in March of 2022. Yet mortgage rates have ebbed and flowed with the data as the Fed interprets how it aligns with their monetary policy goals. Now, mortgage rates play a key role with inventory because it directly impacts affordability. Southern California, and more specifically Orange County, where Brooks and I specialize, continue to struggle with low inventory, but we're seeing some green shoots, and Brooks will touch on this a little later. As we have echoed repeatedly, rates must stabilize at 6.5% and begin trending into the 5% range before inventory really opens up and returns to a more normal market. The easiest way for consumers to see which way mortgage rates may be trending is to follow the 10-year Treasury bond. That said, the best way would be to follow the mortgage-backed securities, but to follow this in real time requires a subscription, which industry professionals utilize. As buyers and sellers, you are probably overwhelmed with the contrasting economic headlines every month, while trying to determine how this impacts your plan to purchase a home, or is this the right time to sell my home? All while you try to manage and maintain everything in your daily lives. Not to mention the stress that inevitably comes with the fact that these endeavors involve the single largest transaction most consumers will make in a lifetime. That's why it is critical to seek out a professional that follows and understands the market data and how it impacts the real estate market, and breaks it down every month in an easy to consume format that you can digest and apply to your own situation. You know what's best for you when the best information is available to you. We do this every week in our private consultations. Hey, it's not lip service when we say we have our finger on the pulse of the market. We use tools to provide the best advice to our clients. For example, we monitor the OC housing market using advanced analytics to ensure our advice to our clients is based on real-time data, which they can rely on when making decisions to buy or sell real estate. These are some of the snapshots of the Orange County market as a whole for houses and condos, but we go a step further and break this down by city for our clients. First, let's look at the Market Action Index for condos in all of Orange County. The Market Action Index identifies whether the demand is balanced or it favors buyers or sellers, as well as what the demand was for the previous month. Second, let's look at the real-time market profile that digs just a little deeper, where key market indicators are displayed in easy-to-read active charts that identify which way indicators are trending. Brooks and I couldn't imagine advising buyers and sellers without using the power of advanced analytics to give them the necessary information to make informed, confident real estate decisions. Now, Brooks is going to take a deeper dive into the market stats that we monitor on a regular basis to better advise our clients on the Orange County market. Brooks?
Thanks, Christopher. We're going to make this quick and to the point. Active listings. The active listing inventory the past couple of weeks increased by 42 homes, up 2%, and now sits at 1,942. It is the second lowest initial February reading since tracking began in 2004, only behind 2022. In January, 35% fewer homes came on the market compared to the 3-year average before COVID, 1,072 less. 277 more sellers came on the market this year compared to January 2023. Last year, there were 2,415 homes on the market, 473 more homes, or 24% higher. The 3-year average before COVID, 2017 to 2019, was 4,843, or 149% extra, more than double. Now demand. The number of pending sales over the prior month soared higher by 280 pending sales in the past 2 weeks, up 28%, and now totals 1,290. Still the lowest initial February reading since tracking began. Last year, there were 1,300 pending sales, 1% more than today. The 3-year average before COVID, 2017 to 2019, was 2,160, or 67% more. With demand soaring compared to the smaller rise in supply, the expected market time, the number of days to sell all Orange County listings at the current buying pace, plunged from 56 to 45 days in the past couple of weeks. It was 56 days last year, slower than today. The 3-year average before COVID, 2017 to 2019, was 70 days, also slower than today. And now lastly, the luxury end. The luxury end, all homes above $2 million account for 35% of the inventory and 13% of demand. Over the past few weeks, the inventory of luxury homes priced above $2 million in Orange County increased from 659 to 675 homes, marking a 2% rise of 16 properties. Concurrently, luxury demand experienced a notable uptick with pending sales increased by 27 or 18%, reaching a total of 179, its highest level since October. This surge in demand, coupled with a comparatively modest increase in supply, led to a significant decrease in the expected market time for luxury homes, dropping from 130 to 113 days, the lowest reading since August. In contrast, homes in lower price ranges below $2 million typically have a much shorter expected market time of 34 days. While 113 days is not immediate, it represents a considerable improvement from the 168-day level recorded at the beginning of December. Despite this positive shift, the recommended strategy for navigating today's luxury market remains cautious pricing and maintaining patience. Year over year, luxury demand has risen by 55 pending sales, a 44% increase, while the active inventory of luxury listings has grown by 83 homes or 14%. Comparatively, last year's expected market time was 143 days, indicating a slower pace than what is observed currently. If you have any questions about the Orange County housing market, drop us a comment or reach out directly with the information below. We hope this video helps keep you informed, and be sure to subscribe to see our next video.